The information provided herein is for general informational purposes only and does not constitute financial, investment, or legal advice. Natural Rewards has a holding in the company and commercial relationship to supply social media design services.
Welcome, Paul Atherley, Executive Chairman of Alkemy Capital PLC, my first guest on the new Natural Rewards show, a new natural resources focused podcast, which I hope to be hosting on a regular, let's say semi-regular basis. So it'd be good to have you on again. We're looking for those diamonds in the rough, those beaten up stocks, the potential 10 baggers out there in the natural resources space, which are really going to reward investors as in the name of the show. So, Paul, I've been trying to get you on for a while, but you've been a hard man to pin down. But welcome on a big news day for Alkemy. Yeah, hopefully this is something which should provide a well-needed pickup for the Alkemy Capital share price, which has been hit quite hard recently, not unlike the rest of the market, actually.
Well, first of all, thanks, Sasha, and it's great that you're out there with your podcast. I think it will be hugely successful, and I'm very pleased and honoured to be your first guest, and very happy to talk about Alkemy and obviously the exciting news we announced today. So, Sasha, the background to Alkemy, as we talked about previously, was we recognise that the UK has an inherent advantage in midstream processing, this idea of chemical parks and bad weather. So essentially, we have these sites called Wilton International, which is in Teesside, which is within a free port and hooked up to offshore wind. And they're brownfield sites, that is, they're predisposed or essentially pre-approved for chemical processing. But each plant obviously has its own more detailed planning approval. But essentially, it's a brownfield site, plug and play for, and we're turning it in for midstream processing. And the first cab off the rank we announced in Alkemy was lithium, and we're now at the point of financing train 1 for lithium. And the way we're looking to finance is at the asset level rather than at the company level. Really, that comes back to the core of what Alkemy is trying to do. Alkemy is a listed vehicle. It's listed on the main board of the London Stock Exchange. It's got a tiny market cap, but it has the advantage is that its projects that it's incubating and developing are going to be financed at the asset level and not at the Alkemy level. So in the case of lithium, we own the 100% of Tees Valley Lithium, which is the subsidiary that's developing it, and we'll be looking to mezzanine finance and bond finance the development of that first train. And Alkemy shareholders will benefit from that incredible leverage you'll have at the asset level. And then this morning we've announced the next metal we're looking to midstream process in the UK, which is graphite. We're very privileged and pleased to announce we've entered into an incorporated joint venture with Syrah Resources, and Syrah is the world's largest operating vertically integrated graphite anode active material producer. It's got a big mine in Mozambique, and they're building a downstream facility in there's Vidalia facility in Louisiana in the United States, and they've been looking to expand into Europe, and we're very, very pleased to say that they've chosen to joint venture with us, with Alkemy, creating this new. We've got this new subsidiary, Tees Valley Graphite, to do very much the same as what we're doing with lithium, is to rapidly progress the approvals and design and engineering of a project, which will essentially be a replication of their facility from Louisiana, except for larger. Louisiana's facility is around 11,000 tons per annum. We're looking at 20,000 tons per annum in the first instance. So Alkemy's strategy is incubating these midstream developments at Wilton, and the financing is at the asset level to give the Alkemy shareholders the kind of leverage that will give the returns that you're talking about, Sasha, the multi-bagger return if it's all successful.
Thanks, Paul. So can we just put the take a step back for a second and put the Syra deal to a side, which looks to be a transformational step forward. I mean, you're partnered with one of the biggest names in the graphite space, and it's obviously a new string to your bow, and it's on a 50-50 deal as well, which is something I'd like to go into later on and how that might look. But over the past 2 years, say, you've done a lot of work in the lithium space with Tees Valley Lithium, and obviously you've set up Tees Valley Graphite as part of the new joint venture. So, with Tees Valley Lithium, you've gone through the feasibility studies, you've got the lease, you've started the financing process, a lot of work done on the funding, which is something we can go into as well. But could you just maybe go back to the beginning and talk about the lithium hydroxide story, and where that sits now when you've got Syra coming in this new deal today?
Well, first of all, to be clear, they're separate. So the Tees Valley Graphite is looking at a site within the Wilton International Chemicals Park, but not on the same location as Tees Valley Lithium. So they're two separate locations, and they'll be funded separately, and they've got separate development profiles. Talking about the development profile of Tees Valley Lithium, you're right. We looked at the ability to bring converted spodumene from Western Australia. They're taking spodumene from a mine which is around 5 or 6% lithium and converting that into primary lithium sulfate in Western Australia, which would be around 30 to 50% lithium, bringing that as a primary lithium sulfate to Wilton and converting that into a lithium hydroxide. Since we've been doing this, the study work, you're probably aware that the battery landscape has changed, and previously it was really easy to separate the two. You had these high energy density nickel, manganese, cobalt batteries, and they would typically be lithiated with a lithium hydroxide, and then you'd have these much lower energy density lithium phosphate batteries, LFP as they're called, and they would be lithiated with a carbonate. And the idea was that the NMC batteries would be more prevalent in Europe, and then these lower energy density batteries will be more prevalent in China and Asia and India. As has happened, things have changed, and the battery chemistry for the nickel, manganese, cobalts has moved from very, very heavily dependent on nickel, so sort of a ratio of 8 nickels to 1 manganese, 1 cobalt, so 8-1-1. They've now moved down to 5-3-2, so 5 nickel, 3 manganese, 2 cobalt. So they're much less energy dense. And then on the LFP side, the LFP batteries have got more powerful, and we've now seen a bit of a crossover. That is, you're seeing there's a bit more of equivalence between the 532s and the LFPs. And then just one other change, if I can just add a bit of a chemistry change in here, is that we've now got this phenomenon called LMFP, lithium manganese iron phosphate. So what you're seeing is a changing battery chemistry, and that plays to our strengths because we can produce either a hydroxide or a carbonate depending on what customers want. And it does appear right now that there is quite a strong demand for carbonate in Europe, which was we didn't really expect that when we went into this. And that again plays to our strengths because our first offtake deal with a group called Wogan, which is a very, very well established lithium trading house, and they will be bringing to us lithium carbonate. It'll either be in the form of a technical grade carbonate, which is relatively high grade, or a crude carbonate, which is slightly lower grade. And then what we will do at Wilton was convert that technical grade or crude carbonate into a battery grade carbonate at Wilton for sale to the battery market. So your question was, what's happening with us in terms of lithium hydroxide? The answer is the market's changed, and there's a bigger demand right now for us anyway to supply the carbonate market. That's not to say there isn't demand for hydroxide, there is, but right now converting carbonate, technical grade and crude carbonate from South America into battery grade for train one is a very, very attractive business plan, and that's the one that we're looking to finance. But we do have plans for 3 more trains, and each one of those trains will be dependent on the market. So there may be train 2 might actually be more orientated toward hydroxide, for instance. So we'll address that when we come to it. So in answer to the question about what's happening with hydroxide, we've migrated to carbonate because that's where the market is, that's where our feedstock's coming from, and that's the one that we're looking to do the mezzanine financing on.
Okay, thank you, Paul. So you could have train 1 producing lithium carbonate for what you think a European market, which is more inclined to demand lithium carbonate. Is that right? And then you've signed the deal, the feedstock deal with Wogan, or an agreement in principle, which we can maybe go into in more detail. And then complementary to this, today's graphite deal with Syrah, right? And does that likely to compete for resources or time, or what's your view on that?
No, it's just to be clear, as I said at the outset, is that they're 2 completely different businesses. So one's Tees Valley Lithium, 100% owned subsidiary of Alkemy. And then we've got Tees Valley Graphite, which is 100% owned subsidiary of Alkemy, which Tees Valley Graphite has done a 50-50 joint venture with Syrah. And so that will be a business that will operate in its own, or resource separately, or fund separately, to develop the graphite side, and the lithium side will develop along the lines we've previously discussed. Is that Alkemy will drive that 100%, and we will finance it at the asset level. So 2 separate businesses.
Okay, well, you're delivering on what you said would be your multi mineral strategy a couple of weeks ago in an RNS, which I think also updated on positive progress on the lithium financing process or funding process, talked about mezzanine, talked about debt, which can maybe go into in a bit. Could you maybe go into, so it's an MOU signed with Syrah at the moment, and what would take that to a binding agreement, and talk about the 50-50 nature of it, what Syrah will be bringing, what you will be bringing. And I think in this particular market, the small caps, the juniors, are obsessed with, quite rightly so, how projects are going to get financed, which you've gone into a little bit, but how would this relationship look like with Syrah when you say, okay, you've got your lithium work stream running, but then you've also got your graphite anode work stream running to set up train 2, or whether that's train 1. Would you be looking to do 50% on debt, and then you'd be left with 50% of the project capex in hand, that half of it would come from Syrah and half would come from yourselves, or together you'd go out and look for other ways of doing it? What are you envisaging in your mind? And I know that there were a few things mentioned in the RNS with the green bond, the mezzanine, but how would that come together? I think I've asked you quite a lot of questions there, but maybe start with the MOU first.
Well, just going back to the lithium, the lithium is financing now. So the lithium financing, we've said this, we're looking to do a mezzanine finance now that will go up to get taken out by a bond, and the bond will be the main finance. So the point about the mezzanine finance is the lithium project is at what's called a class 4 engineering study. It needs to go through FEED, front-end engineering design, needs to secure all the feedstock and the offtake arrangements need to be formalized into the necessary agreements to support the finance. There's a whole bunch of other things that you go through. So basically, that's what the mezzanine finance funds. And when that's all complete, we then draw down, we issue the bond, and the bond takes out the mezzanine funding. And alongside the mezzanine funding, we have equity participants. So that's the structure at the asset level. This is at the Tees Valley Lithium level. We are looking to replicate that for Tees Valley Graphite. Having said that, Tees Valley Graphite is not at that stage. Tees Valley Graphite is at least 12 months prior to that. So Tees Valley Graphite is at an unincorporated joint venture stage. It will go and do a study equivalent to a definitive or bankable feasibility study based on the plug-and-play nature of Wilton. That's everything that we're bringing to the table in terms of Wilton, power, water, services, all of those things, approvals, all of those elements that you need. And then what Syrah are bringing is their experience with a process facility they're building in the United States, the Vidalia plant in Louisiana, which they're building 11,000 tons per annum, and we'll work with their engineering team to scale that up to 20,000 tons per annum. And all that will form a study that will go to the respective boards. We'll go to TVG and we'll go to CIRA. And if the parties then say, look, this is a go, we want to do it, we then incorporate the joint venture and we bring the finance that we'll be working with along the way to bear and go ahead and build the project, make it happen. So it's an accelerated process that will have a decision point, and often called, final investment decision, when all those elements are done.
What's the next step? So what's the next step in the MOU then, Paul?
So we've announced an MOU. We need to turn that into a binding document, and we expect that to take a few weeks. We'll announce that, and that will be what's called the unincorporated joint venture, which will be the basis in which we work together to complete the bankable feasibility study.
Okay, I'm glad you mentioned Wogen earlier on. Am I saying that right? Is it Wogen or Wogen? Could you tell us a little bit more about those guys?
So Wogen, or Wujian, I think is their originating name. I think Wu was in 5, Chinese for 5, Mandarin for 5, and Jian or Jin, I think, comes from the word for gold or for metal. So it's 5 metals. They've been around for a long time, and they've got very, very good contacts with in the lithium sector. And they've got access to mines and to offtake agreements that they'll bring to us. Their role is that. Their role is sourcing, logistics, supply, all of that delivery to us as feedstock to initially for train 1. And then we may or may not work with them on the offtake side as well. We might source the offtake, or they might source the offtake, or the customer they're working with, they might source the offtake. So each one of the arrangements might be slightly different, but that's their role. The primary role is to facilitate the feedstock, assist where required with the offtake.
You talked about the multi-mineral strategy for in a previous release, and you've just added graphite, and you talked about manganese a little while ago and nickel. Do you have ambitions to add on further minerals? Can I just ask, is there something else that you have other interested partners who, because it's quite an interesting little space here, and I don't know, your first mover advantage, not in just one critical mineral, but maybe several, might make you just so much more attractive on any level, from your offtake partners, from suppliers, from private equity groups who might want to invest, some of the institutional market. It's quite an interesting offering. But over to you. I guess you've got lithium, you've just got a big graphite deal. I don't know quite what else is there to look at, and whether the margins might be good enough for you, but maybe just something to touch upon.
Well, just to understand the way we look at the market, we think the market's bifurcating or dividing. Basically, China is very, very demanding in terms of price and costs. So we're seeing that's a very cost-driven midstream market. We think the European market will diverge from that, because the midstream market has a lot of requirements on the chemicals that are produced and supplied around Europe. For instance, REACH regulations, rules of origin, carbon content, transparency, etc. So basically, it's a different product that you're going to produce in Europe. And the best place to produce these chemicals that these customers want is actually on their doorstep, and that's meaning in Europe. And the best place to produce midstream products in Europe is in a chemical park. And we think the best place in the chemical park is one that's hooked up to offshore wind and one that's in a free port.
Yeah.
So they're all the elements. And that's why Teesside and Wilton stands out so well against possibly some of its competitors across Europe. So we see there's a very large amount of investment in the chemical industry in Germany, in Saxony, for instance, southeast Germany. But Saxony is not on the coast and has much more challenging transport logistics than we have, for instance. And I can give you examples for other locations. So in terms of geography, the chemical park, the link to offshore wind, the free port, and the processing relief and all the plug and play aspect of Wilton, we think Wilton is the best site, chemical site in Europe. As a strategy, as a company, we want to take the cookie cutter approach. So to the extent that it's possible, we are looking at train 1 for lithium, and then would like to do 4 trains. In other words, just replicate the model. And we've talked to our bond financiers about a series of bonds, a bond series rather than just one bond. In other words, once you've done one, you can draw down the others. And then, as you mentioned, so if you like, we're looking at the scalability on the lithium side, but we're also looking at, if you want to call it, diversification on the metal side. So we've as you mentioned, we've announced graphite this morning, and we are looking at manganese, because these very much fit the same kind of model. They can be brought into the UK at relatively high concentration. That is, we're not shipping lots of waste around the world. It's why high valuable, high concentration product, and then converted from a concentrated product to essentially a battery grade product. That's what our job will be, but doing it in a way that has several advantages. One is the cost, because it's at scale, it's efficient. 2 is we're accessing offshore wind, so it's got a very low embedded carbon. And 3 is we've got this cluster effect. So in some of our processes, we actually might produce a waste product that somebody else wants to buy. So if we were a standalone project in the middle of, somewhere which doesn't have the cluster effect, we do have to go and ship this stuff and do something with it. We're fortunate that in Teesside, there's a lot of customers for the kind of byproducts that we'll produce. So they're the main advantages, and that's why we want to get going. Oh, and the other advantage, of course, it's in the UK and it's very financeable. So we think the model is scalable and diversifiable across those 3 metals. And as you say, first mover advantages works because, quite frankly, approval processes and to get these things done in the UK is a lot faster than I'm suggesting than most other areas in Europe. So yeah, first mover advantage, 3 very, very exciting metals, and scalable.
So it's all about getting the first cab off the rank then, Paul. We're talking about the lithium funding, which you've talked about. Could you explain where you are with the green bond and mezzanine a little bit, just a little bit more detail for how it would work and the mechanics of it? So as I understand, you're looking to do some mezzanine finance to bring in, I don't know how much, maybe you can go into a bit more detail there, and that will drive forward the studies and I think it'll add a lot of, it'll de-risk the project usually for the market at the moment, and I think that's the major catalyst which might set this alight. Although I'm very surprised that the market hasn't reacted usually to the deal with Sara, given their connections with all the tier. I mean, do they not supply Tesla? And they're setting this up in the States. They're the only major Western company producing graphite anode outside of China. Right? That's right? And
Right.
so the model will just be replicating what they're already doing over there. They know their model works, the technology works, the feasibility study works, but I think the market is just focusing on this one item that it wants ticked, and that's the mezzanine, which you talked about a little bit and you've updated on recently, but potentially a little more. Can you give us a little more detail on that and when we might expect to hear more?
Sure. So there's 4 elements we need for each of these trains. Doesn't matter if it's lithium or graphite. We need an engineering study. We need planning permission. We need feedstock, and the last one is we need finance. So you're quite right, is that everyone says great design, great idea, like it, lot, fit works. Show me the money is really the call, and we're working with the financiers now. And as soon as we have something we can announce, we'll announce that. So fortunately, there's not a lot I can say at this point other than we've got a very, very detailed financial model that is with the mezzanine financiers now, and we'll see whether we're able to progress that in the near term. The way it would work, if it did work, and we're not trying to represent to anybody this is done, but the way the idea is that the mezzanine financiers give us a mezzanine facility that then gets taken out by the bond. And if you say the capital cost of the train one for lithium is about $300 million. When I say $300 million, it's $300 million including add-ons and working capital facilities and capitalization of interest, etc. So basically it's a $300 million-ish package. So you say the bond guys will do 60% of that, so $180 million. So they'll also need to take out the mezzanine if the mezzanine is somewhere between $20 and $30 million. So you're talking about a bond financing of $200 million. And then against that, you need $120 million worth of equity. We're reasonably well down the track in all three of those elements. So as I say, we've started the process with the mezzanine financiers. The bond guys basically said, look, if you can take this through feed studies and get this all signed off, all the elements they require, then the bond looks good. In fact, I'm actually meeting with a potential investor in the bond for the bond this week. You know, there's a lot of interest in that bond. You know, it's very attractive. And then the equity that goes alongside the bond, those of you familiar with the bond market, it's not uncommon for bond financiers to have an equity component as well. And remember, this is private, not public companies. We're doing private law. There's a lot of equity available for this kind of infrastructure project in the UK. So we've got people offering us interest in that. So the key, I think, is at the project levels. The key is what you've said right from the beginning. You've said several times in the interview, is we need to demonstrate the mezzanine finance, and I think that unlocks the whole model. And once it works for lithium, for the train one on lithium, then it should be relatively transferable to graphite.
Yeah, 100%. So you've talked about the feasibility study, existing work being at class 4, which is, I think, even more detailed than a feasibility study, and you've got feed studies going on now, which is front-end design engineering, getting a view on contracts, which is really important in this, for the debt financiers, because they want to know who's coming in to deliver the work, how secure or how firm their pricing models are, what how sensitive it is to, or robust it is to inflation, potentially, all that kind of thing. Am I right? Could you maybe talk about where you are with that work as well, and when we're likely to see further progress there?
Well, I can't give you any timing, Sash, at this point, but I can say what we're doing. So all the things you talked about is the feedstock arrangements, the off-taking arrangements, moving the engineering studies from class 4 through feed, and appointing all of the various engineering companies along the way to do that. And you end up with 50 or 60 equipment packages that have to be signed off, and each one of those will have to be interrogated by the credit analyst for the bond. All of that work is what we need the mezzanine finance money for. It takes us through quite a period of time, but the end point of that is that we end up with a fully engineered, with contractual obligations for feedstock, contractual obligations for offtake, contractual obligations for all the service providers and for the equipment providers, to put the whole thing together. And the bond sits over the top of that, and the bond financiers monitor it very, very closely, the deployment of funds whilst the project's being built. So we've started that process, and remembering this process is somebody providing all of the finance, not the Alkemy shareholders. So this is a completely standalone financing. So yeah, it's there's a level of detail that they go into because they're taking a big part of the risk.
Okay, Paul. I think that's enough on financing now. So you're making progress on the mezzanine, which opens up the feed study completion, and that's where we are. But you've also started that process as well, I believe. So do you want to talk about Pensana at all? You've been kicking a few goals there.
Sure. So Pensana is we had an investor who was going to put in $200 million into the company early last year, and they didn't get across the line at the last minute. And so we basically had to go and re-engineer the project, which we did. We reduced the front end. We separated the project from the separation facility in the UK, the mine in Angola, and focused only on the mine for the time being, and came up with a re-engineering of making a $200 million project, not a $300 million project, which we felt was more financeable. That work's all been done. We've had there's been a technical review of it, and it looks good. And we're now doing this financing that we're just talking about for lithium. We're actually doing the main financing bit for Pensana now, and we're working through that, and it's looking good. So we've pretty much, if you like, past the engineering stage, past all the pre-development phase, and we're in the nitty gritty of the financing right now. So yeah, we're hoping we will be able to get that across the line. We've already drawn down. We have a facility of $15 million to commence the work on the ground, which we've been doing. So we've reformulated the road between the mine and the railway station. We put in foundations, sewers, amenities, foundations, amenities block. We've connected in power. All those foundation stuff you'd expect for a pre-development. We've started constructing a 350-man site, and a modular plant up in Johannesburg, which we'll bring to site. In fact, the project itself will get developed having equipment packages developed off-site and then brought on site and bolted together, which is one of the advantages of this big railway line. We've got the Lobito corridor. We can easily bring modules in on that basis. So Pensana's at a very, very exciting phase. We are hoping to get finance in place such that we can finish all this preparatory earthworks by May of this year. In one of our most recent presentations, we're showing main construction from June onwards. So that would imply that to achieve that, we would have to put finance in place ahead of that.
The reason I asked that, for context for anyone who might not know, is that Paul is executive chairman of Pensana as well, and there are many shareholders who in Alkemy who also follow Pensana very closely, and you've been making great progress there. And I think that project is a lot further advanced, as is the financing. So people like to see those goals kicked there, because I think it'll reflect well on Alkemy as well. I think the two are becoming a little bit linked. But maybe let's talk about another link here. The share price has come off a lot, and I don't think it's a complete coincidence that the lithium prices have dropped off a hell of a lot. And we've seen lithium, the exponential success in lithium has been it's been the darling of the Australian stock market particularly, and it must have made a lot of fortunes over there. And I can't help that we've been caught up in that somehow, and I think it's somewhat unfair, and I don't know if I'm correct here, but we're a margin business on processing, right? The margins would get tighter or maybe wider as supply goes up and down of the product. But is that right? But what do you think? Do you think the drop off in lithium has had a negative effect on the Pensana share price, let's say in the last few weeks, the last couple of months?
So I think it's had a negative impact on the Alkemy share price for sure, but that will flush it. That will work its way through, because most of those shareholders who have sold or are selling are the Australian holders who, quite frankly, are seeing many of their other lithium holdings being beaten up in the Australian market. But it actually plays to Alkemy's strengths, because I was in Australia earlier last year, talking about that when the lithium prices are high and there's a lot of demand for the spodumene concentrate, the prices at the mine gates are very, very high, and the miners make a very, very big margin. That's now changed, and so that the miners' margins don't look quite so good. Plus, we have another factor, independent of that, is that in Australia, the capital costs of these projects are turn out to be much higher than expected. In some cases, the operating costs as well. So it means that the margin at the mine gate is nothing like what it was when people originally invested in the sector. So they're now rotating out of the miners. But that doesn't mean to say that the margin for the midstream processors has got any worse. In actual fact, because there's going to be so much lower cost spodumene around and potentially lower cost technical grade carbonate and crude carbonate, it means that the buying cost for us, if you like, is going to be lower than it was before, and that the selling cost maybe has come down, but not come down as much as the mine cost. So in other words, it's quite possible for refiners, for their margins to actually look better in a tighter market than the one where we previously experienced. So I think the margins of the mine gate have been compressed, but the margins at the midstream still look quite good. And in fact, when you see miners cutting back production, it means that they've got excess capacity at the mine gate. When you've got excess capacity at the mine gate, it drives down the mine gate price, but doesn't necessarily apply to the midstream because there isn't an excess capacity in the midstream. In fact, there's a shortage of capacity in the midstream, and that's why we're building this facility in Europe. So I think we're well placed to take advantage from the current downturn in lithium prices. And to your point about the share price, yes, number of shareholders are selling out of battery minerals, full stop. And Alkemy's got caught up in that a little bit. But that's a finite amount of shares. And once they've gone, then the people who are investing, shall I say, in Wilton, the Wilton strategy, they will be able to see through that and look at it as a margin play based in the UK rather than blowing in the wind on the lithium prices we see some of these lithium juniors.
Yeah. Okay. No, that makes a lot of sense. So you talked about a limited amount of shares. You've only got about 8 million shares listed. Is that right? I can't remember the exact number, and maybe half are with management, a bit less than half. All right.
That's right.
Yeah.
It's super tight. It's more like a US stock, and when there's more buyers than sellers, there's not much stock around. It will. I've got no doubt it will.
We just need to come out of this stuck in the mud period that it's been a horrible January for everyone. You've got more to market now, and you've got the Cyrus story is very good. You've got a number of irons in the fire and potential news flow to come now. So you've got quite a lot to talk about now. One question I've been asked to ask you, or requested to ask you, is about institutionalizing the register a bit more. Appreciating it's a small market cap at the moment, but what thoughts have you got in that regard at the moment?
Very much so. So we're obviously what's weighing against us is we've got a tiny market cap, but that doesn't mean we won't get in front of the institutional investors to make them aware of the story. Then as we grow, give them an opportunity to come on board. So yes, that would be the case. But to be frank, we need, we've got a market cap of 10 million pounds. We need 100 million pounds plus. We need to be 10 times bigger. So the share price needs to be closer to 10 pounds rather than £1 for us to be able to do that.
Paul, a couple of things to wrap up on. What's next for each of Tees Valley Lithium, Tees Valley Graphite? What are we likely to see in the near term?
Sasha, the key for Tees Valley Lithium is the mezzanine finance, which we're working on now. And for Tees Valley Graphite, as we chatted about, we're going to announce the unincorporated joint venture and get going on that.
In keeping with the theme of the show, that of investors looking for a rewarding outcome from their investment, could you please give our listeners some closing remarks in this regard? I note that I haven't seen an update today from the broker, but there was recently I think a 14 or 15 pound price target put on Tees Valley Lithium alone. So we're sitting at about 80 something pence, 80 to 90 I think today. So yeah, over to you. Talk about where you're seeing this going.
So our view is we're a £25 stock if we are able to kick these goals, and we've delivered everything we said we are going to do to date on the lithium front. We've got one more thing to do, which is the mezzanine. And my personal view is that should unlock, you know, 1 to 300 million pounds worth of value, which is sort of 10 to 20 pounds a share. And then you just add graphite on top of that. The graphite's at a study phase, so you can't attribute much economic value to it at this point. But if it does get to final investment decision, it does go ahead, then you put some financial metrics around it. And I suspect they'll be as good as lithium, if not better. So you can say it's got potential for that again. So yeah, we think this is fits very much the criteria you're looking for. It's the multi-bagger in a relatively short period of time.
Thank you for your time today, Paul, and we'll be looking forward to hearing lots more in the near future.
Thank you, Sasha. Really enjoyed that. Thank you. Bye-bye.